Hello, real estate investors. I'm Jana Cristo, and I'm the publisher of Frenzy.com, online real estate resource for real estate investors and landlords. Today's topic is how to prevent the tax hit when you sell your rental property. And I've invited Michael Eric Scott, a CPA with over 40 years of experience, to help us navigate this topic. And I don't want to forget anything because Michael bio is long and he's done a lot of things. He has a master's degree in accounting, and he has worked for firms such as PricewaterhouseCoopers and IBM. And he has also run his own accounting practice for 17 years. And he's the author of the book, US Tax and SAP. I hope I'm pronouncing that correct. He has taught accounting at the University of Texas at Arlington and Navarro College. Michael also runs the Video CPA YouTube channel, and is the owner behind and the force behind Video CPA's targeted tax training school. Michael, I'm just tired reading all of this. How do you have the time to do this?
Well, I am still working a little bit, but for the most part, I'm retired, and so I do I keep very active, but I do the two YouTube channels, and then I've got the school. But on the other hand, I do a lot of activities like pickleball and bowling and anything I want to. So I just keep myself busy.
Well, that's a secret right there. So I'm really glad you found the time to help me out. And I watched some of your videos on the subject, especially the depreciation recapture. And I'm really excited to actually learn from you. And let's start with the simple question.
Okay.
If I'm a real estate investor and I'm selling my rental properties, what kind of taxes should I expect? And you mentioned that I should ask about basis, and just to give you some background on myself, I learned accounting. This was not my major, but I learned accounting in Catholic school, and I'm still afraid of the nuns who taught the class. It was really scary. I actually dropped the class. So explain it to me very, simply so I can understand. And the reason I also picked this topic is a lot of the prices of real estate have gone up dramatically. A lot of investors are selling, and they're finding that some of the taxes, like depreciation, they didn't expect to pay that because they didn't deduct it during the time they owned the property.
Okay.
So that's why, my first question, what exactly an investor would expect to pay?
Well, there's two types of taxes. In Florida, I don't think you have a state income tax, do you? But I can't remember. But certainly a federal income tax and possibly a state income tax on the sale of a rental property.
Mm-hmm.
The problem is, if you the way the IRS wrote the law is that it's depreciable. It's depreciated or depreciable. Okay, so if you fail to take depreciation during the time that you've had that rental property, the IRS doesn't care. They would just as soon you go back and amend all your returns to take that depreciation, or use some other method to take that depreciation at some point in time on a return. But
I'm sorry, I don't want to interrupt you, but you can amend going back how many years?
well, you can't amend certainly if you've got a commercial property that's on a 39-year-old basis. You can't amend 39 years. You can amend generally back 3 years at least, and possibly four, depending on the when the return was filed. But
Mhm.
so if you haven't taken depreciation, the IRS doesn't care usually. I mean, they say it's depreciable. It's you've either depreciated or it's depreciable, and you should have taken the depreciation. So that does, I mean, that does uh, hook a lot of people. Even if they've taken depreciation and they know they've taken depreciation, sometimes individuals don't know that that depreciation is recaptured on sale.
Mm.
And so when you sell a property, the depreciation that you've taken on that property is actually calculated in as part of the gain on the sale. So with that in mind, let me talk about basis just a little bit.
Mhm.
Okay. So basis is actually the cost that you've got in the building. Okay. So your basis, if you buy a piece of rental property, you're going to have, and say you pay $210,000 for it.
Mhm.
Okay. The $210,000 becomes your basis in the property. Now, that's not necessarily the depreciable basis because you have to subtract the land value out of that.
Mhm.
And most times when you buy property, they don't tell you what that land value is. So you've got to estimate what the land value is. So when you're doing depreciation, you've got the cost that you paid for the property minus the land, and that would give you uh, your basis for depreciation. But then you have to add in any purchasing expenses that you've incurred when you buy that property.
Mhm.
And that's not taxes or interest because those things can be written off, and you may pay those things at closing, but those taxes and interest can be written off on an annual
Mm.
basis. So it's things like all the closing costs that they stick you with for uh, different types of recording fees, that type of thing. And so
Mhm.
if you look at your HUD 1 statement, um, pretty much most of the stuff on there would be written off as that basis. And I've got a YouTube video out there actually on
Mhm.
calculating your basis. But so as you go along, then that basis then is deducted by the amount of depreciation you take. So if you buy it for $110,000 and you've taken say $20,000 worth of depreciation, your basis on that property is uh, is 190,000 now because it reduces the costs in there. So when you sell it, then you're looking at a profit in that case of $20,000 just on depreciation. If the building appreciates in value, well, then you've got an additional profit there. But
Hmm.
so the depreciation was recovered, and it's recovered at a maximum rate of 25%.
Well.
So generally, it's recovered at ordinary income rates or a maximum of 25%.
Mhm.
And that is called a unrecaptured Section 1250 gain. All right.
Okay.
So if you make money on a property, the depreciation recapture is the unrecaptured 1250 Section 1250 gain.
Mhm.
All right. Any other gain that's above that depreciation recapture then would be at ordinary income rates. And most people don't understand that. So they think they're getting capital gain treatment on the whole thing.
Mhm.
And, essentially they're not because the capital gain rate, the maximum capital gain rate is 25%. If you're in a lower rate than that, you get the ordinary income rate on your
Mhm.
depreciation recapture.
Mhm.
But on the rest of the gain, you do get your capital gain rates.
Okay, that's clear to
Yeah,
me.
I don't know if you understand that or not, but
I do mostly because I read about it a little bit, so it
okay,
just
okay.
and I watched your video. So that is clear. So just a question: if somebody did not take this did not take depreciation. It's just they are lost in. It's like they should have. That's
Yeah, there is, yeah, I mean, they should have, right, but there is a allowance, I think, and I haven't done this for a while, that you can take some of that depreciation when you sell it, but
okay. So it's not the total loss.
no, not totally.
No. Okay. Um, if so, what is the, like, for example, if somebody doesn't want to pay those taxes, what are the options?
They don't want to pay their capital gain taxes on the
Yeah.
gain. Well, the option is to pay big penalties and go to jail. Well, the
Well,
IRS doesn't put anybody in jail, but
something a little bit
you know,
easier.
eventually, if they don't pay them, they're going to get a lien against all their other properties on them. So,
Um, can they exchange it for another property? Like,
oh,
is
okay,
that
yes, they could exchange it for a like kind type property, and most of the like kind exchanges have been done away with, except in the real estate area. Used to be, you
Mhm.
know, that you trade in a car and you can do a like kind exchange on an automobile, and you just trade it in and get another one, and there's
Oh,
no
right.
gain or loss. That's all gone. But on real estate, you can still do that. So there is an opportunity if they would just as soon do a like kind exchange, they can delay the any tax on the sale on the property by doing a like kind exchange.
Like kind of exchange. Can you, if you're selling, let's say, a couple of single family homes, can you exchange this for a multi-family home? Would that be a like kind
Yeah,
exchange?
as long as it's real estate for real estate, you're in pretty good shape.
Okay,
Yeah, you can do that.
you can do that. Um, one more question, because I mean, people, when they find, investors, when they find how much money they have to pay in taxes, they are looking for the other options, and of course 1031 exchange is one thing.
Right.
But some, I've heard and I've read some discussions about, can they do seller financing and sell the property? Would that be, how would that be treated?
Yeah, I mean that would be an installment sale, and that would spread out the taxes on it. The only problem is you do an installment sale, you've got to have a pretty good buyer because sometimes you have to take that property back because you don't get your payments, you know. But
Yeah.
an installment sale does work. I mean, and what it does, if you take a note for 20 years, it will prorate the gain over a 20-year period so that you don't pay that taxes all up front.
Hmm.
So that is another way to do it.
Okay. Um, what if you sell the note?
Well, yeah, if selling the note's not going to make any difference. I mean, if you, oh, okay, I see what you're saying. Yeah, I mean, if you take the note through an installment sale, and then you turn around and collect some payments on it, and then sell the note. Unfortunately, the sale of that note, generally, you're going to sell it as at a loss because it's discounted.
Yes.
But there's still going to be some taxes on it. You're going to have to calculate the loss on the sale of that note, and then compare that to the gain on it, and calculate the difference.
Yeah. That
So,
doesn't sound like a good idea.
yeah,
Now
yeah, I think kind of
that you explained it.
I've never
But
seen that done actually. So
yeah, okay. So those are the two options, like 1031 and the in the installment sale if you have a good buyer. And of
yes.
course, with the installment sale, you're not gonna get the cash immediately as you would. So yeah, well, I think that's clear. I mean, those are really the questions that I had for you. Yeah, that's pretty much what I have. And we talked about basis, and I think you explained everything pretty well. Now, if somebody wants to learn more about this, where they should go, like what is is your YouTube channel better?
Yeah, well, there's I think I have 9 courses on real estate or 9 videos on real estate out on
Mm-hmm.
that YouTube channel.
Okay.
If they need more, well, then they'd have to go to my targeted tax training site, which is the Video CPA, www.thevideocpa.com.
Okay.
Uh, and those are actual courses, though. I mean, they're longer than the videos and in more detail than the YouTube videos.
Mm-hmm.
They actually incorporate the YouTube videos in them, but they've got a lot of text in them and quizzes and stuff like that in them as well. So
Okay. Well, I will include this in the description of the video, and I will also transcribe our conversation so people can read it as a blog post, and I'll just link to all of that. Because personally, I don't watch a lot of videos. I much prefer to read. So, but we'll have it in video form and also transcribed. So,
okay.
um, I think that's it. I mean, can I mm, call you again if I have another question?
Oh, sure, Janet, that'd be fine.
Okay, great. Well, thank you so much, Michael. Appreciate it.
Okay, bye.
Thanks. Bye.